It's a great idea to diversify your investments. That's why when you're building a portfolio, asset allocation is considered to be key. Allocation between equity, fixed income, and also commodities, and specifically gold, is something that a lot of financial planners will talk to you about. But even within equity, it's a great idea to diversify, and that's where investing abroad comes in. Now, in years gone by, the ability of Indian investors to invest abroad was highly limited, but that has changed dramatically with mutual funds offering products that allow you to do so. And now there are several routes that allow you to invest in companies directly. My guest today is Prableen Bajpai, who is the founder of FinFix. It's a pleasure, as always, to have you on the show, Prableen. Thanks so much for taking the time. I want to start by asking, however, in the current context, is it really a necessity or something that is lucrative to consider to invest abroad, considering the kind of opportunities we have here in India?
Good evening, Alex, and I hope that you're doing perfectly fine now. Yes, I would say that the answer is yes, that I think there is a very compelling case to investing outside India, and I'll give some reasons for that. If we look at the size of the Indian economy and our percentage in the overall global market capitalization, we are at about 3 to 4% for each. That means that there is a 96 to 97% investment canvas which is there outside India, and that I think is the first and a very strong reason to invest abroad. There are so many themes, there are so many emerging technologies which are not available in India. The work is being done, but they're not available in India via listed companies. If you look at the top 10 R&D spenders globally, you will not find a single Indian company there. You will have companies from US, you can see a Chinese company, you can see a company from South Korea. Likewise, for global top 10 patent holders, again, you will not find India. So India is a great story in terms of growth, but when it comes to innovation, I would say that a lot of important work is actually being done outside India. That's the second reason, Alex. Thirdly, I think is just the way you mentioned, diversification. So investing outside India actually helps investors to diversify and reduce certain kind of risks, specifically the country risk as well as the currency risk. We all work in India, we have a property in India, we are investing in India. So somewhere the whole allocation, I mean, our whole world is our country. So some amount of allocation outside, especially as investors are looking to send their kids abroad for studies or travel abroad, I think again is important thing to have a certain amount of your portfolio in those markets as well. And I think fourthly is the role of currency. As I mentioned that, it also reduces the currency risk. And we've seen over the last 10 years that USD has appreciated against the INR by over 65%. So when an investor is investing abroad and there is a rupee depreciation, Alex, that actually adds to the returns of an Indian investor. So I think all these factors are definitely, together, I think present a case for investing outside.
I think you've elucidated this point very, very clearly, Prableen, like you normally do. But let's talk about the avenues that are available. And like I was saying in the introduction to this conversation, there are now several more avenues available. And I think it may be fair to say also that in 2021, one of the flavors of the season was the overseas funds or investments into funds that allowed you to have access to investments overseas. So what are the options available if somebody were to consider this?
Alex, I think though I've said that investing outside is a great thing for an investor's portfolio, it is equally important for investors to look at the right route to invest abroad and also invest for the right reasons. Because especially in the last 3 years, we've seen the US markets give phenomenal returns. So the recency bias shouldn't be the driving factor. And I think the rising awareness is, encouraging more and more people to invest abroad, but it should be for the right reason. Having said that, there are broadly two ways to invest outside. One is via mutual fund routes. And I can just split up, the different ways that we have within mutual funds. The first would be the passive route, wherein index abroad is just tracked by an Indian fund. So it's a passive way of taking exposure to stocks in US, or it can be stocks in Hong Kong or stocks in any other country. Second would be an active route. Active route can be two ways again, where the Indian fund manager, the AMC, is holding its own brokerage firms abroad, its own stock portfolios and through brokerage firms abroad, and managing the whole portfolio. So that's totally active management. And the fund managers, the Indian fund managers, are managing it. For example, ICICI's US Blue Chip Fund is one example. And then you have other sort of active funds wherein the underlying fund is actually managed by an overseas fund manager. For example, the PGIM Global Opportunities, the underlying fund is the active fund, which is the Jennison PGIM Global Opportunities Fund. And third, Alex, through mutual funds is taking partial exposure. We have funds from different categories, be it a value fund, it can be the flexi cap fund, the focused category, the mid and the large cap, where there are certain mutual funds in India which allow up to, which are actually investing up to 35%. So they retain that 65% allocation in Indian equities to ensure that they're getting the equity taxation in India, but they are using up that 35% to invest abroad. So that's within the mutual funds actually. And then other than these, there are direct ways to invest abroad. And again, it has three different categories in that, Alex. So the first way would be that investor is investing through his own brokerage firm in India. For example, I am investing with Kotak Securities for my Indian stock portfolio. And Kotak Securities, through its own tie-up with Interactive Brokers, allows me to invest in US stocks or other stocks outside India. The second medium here, Alex, is through a lot of these new technology platforms which have come up. Some names are Vested, Globalize, IND Money. Some of these are actually registered as advisors with the Securities and Exchange Commission in the US. But they are just enablers. So it's a platform, and they further have a tie-up with the brokerage firm in the US through which an investor would finally make their investments. And the third way here is, as an Indian investor, I can directly open a brokerage account with certain brokerage firms which allow me to open an account with them. TD Ameritrade is one, Interactive Brokers is one, Charles Schwab's is another one, who, all of them allow global investors to open accounts with them and invest.
Prableen, you've made some very interesting points about the modes that you can choose and also the pros and cons of investing in equity abroad. But there are limits to bear in mind in terms of LRS, right? And what approach should one have ideally, and I'm talking about the average retail investor here, to investing abroad?
There are certain limitations, but I think one point which all investors need to understand here is that when we're looking at investing outside India via mutual funds, that is not covered under the liberalized remittance scheme. So whatever transactions are done through a mutual fund, that won't be counted or make a part of your LRS. Only when we are investing in stocks outside India directly through any of the three mediums that I had mentioned, they come under LRS. And LRS is simply a facilitation which was started by the Reserve Bank of India in the year 2004, which allows Indians to remit up to 250,000 US dollars outside India. So in a year, in a financial year, it is equivalent to about 1.9 crores. So that's the amount of money that you can send abroad, remit abroad, because this can cover, things like child's education, buying some other asset abroad, or your direct in equities. So when investors looking to invest outside India, Alex, I think a couple of things now they should, kind of look at first. One is just like a portfolio, when we construct it for our Indian investments, we create a core and a satellite. So I think the similar approach should be used for investing outside India also. So your core has to be, I think, a simplistic product, probably a passive fund, which is giving you exposure to more developed markets because there is more information that we have of these markets. The companies are more familiar. Developed markets, especially like the US, because I think we are all more aware of companies like Zoom. We are having the interview over companies like Apple, Uber, Airbnb, which we're using. So probably it's a good idea to create a portfolio in the developed markets through a passive route, and then create a satellite for yourself. It can be either through mutual funds or some other preferred route into stocks which are probably from other geographies. And of course, all of this has to boil down to that it's equities at the end of the day, Alex. So the risk appetite, the time horizon that any investor needs to give must be similar. You cannot expect a supernormal returns, in a year's time. So the investment horizon must be long. I would say minimum 2 to 3 years, especially also because from the taxation point of view, the long term, definitely what is, what's ideal is 5 years and plus.
Understood. And that's a fair point that you're making, because ultimately the investment vehicle is equities, and equities have to be given enough time, Prableen, as is normally the case, right? And as advisors like you always point out, what is the requirement in terms of documentation, and what are the compliance issues that one must bear in mind when they decide to invest abroad? Is there something in particular that investors should focus on?
Again, for mutual funds, there's nothing different that investors need to do. But if they're investing directly abroad, there are a couple of things that they again need to know. The process of opening a brokerage account is it's quite straightforward and simple. All you need is your PAN card, or probably they can ask for your passport and your Aadhaar and other details for address proof. I think the compliance issue, a bit of it comes when we do a wire transfer, because a wire transfer here comes under LRS, and as per the LRS guidelines, your bank would ask you to fill a form which is called Form A2 and a declaration, wherein the purpose of the remittance is mentioned. So when you're investing directly abroad, it would be investing in equities abroad. So these two are the forms which need to be filled. And part of it now, a lot of platforms facilitate as well, Alex, where they are guiding investors how to go about it. But these are mandatory requirements. And if I, as an investor, I'm opening a direct brokerage account, let's say with AmriTrade or Interactive Brokers, then they may ask me to also submit a form which is called the W8BEN, which shows that I am a person not from the US and my primary source of income is in India, because in terms of a dividend, whenever there is a dividend which is declared, there might be some withholding tax. So this form comes in handy there.
Absolutely. Now, it brings us to the last question, which is in terms of taxation. What does one have to bear in mind, Prableen, in terms of investing in these assets, in terms of investing in these companies? If you are, for example, investing in a FANG, what does one need to bear in mind in terms of taxation?
Right. So taxation, when we are looking at mutual funds, Alex, the taxation for any investment outside India is not considered as equity. That means the long term and short term is not actually the typical 1 year and 1 year plus. It becomes like debt taxation. So it is long, your short term is, up to 3 years. And after that, it is considered as long term. So if I'm investing as a US fund or a FANG fund or the NYSE fund or any other S&P fund, if I am redeeming my money within 3 years, I have to pay a tax based on my income slab. And if I'm redeeming after 3 years, then I can avail indexation, just like we do in debt funds, and pay the taxes. So the taxation for investing outside through mutual funds is non-equity. Now let's come to direct investing. If you're looking at direct investing, I'll just split it up into two things. One is taxation and one is costs. So certain amount of costs would be there, Alex, because when they're doing the wire transfer, there would be a currency conversion, there would be a processing fee. The banks, charge their own remittance charges. So that's one aspect of the whole cost thing, which is there when you're doing a direct remittance abroad through any of the brokerage accounts or through these platforms. and then the taxation part. So there is no tax deducted at source for the profits which are earned on any of the stocks that I'm holding in US. And the short term and the long term is not 3 years, it is 2 years. So if I'm redeeming and selling, let's say I'm holding Tesla and I sell it after 1.5 years, whatever profits I make will be added to my taxable income. And if I sell it after 2 years, then I can avail indexation and it is considered as long term. But if any of these companies which I'm holding abroad declares a dividend, then there is a 25% TDS which is deducted by the US entity. And under the double taxation agreement that we have with the US, when I would file my taxes, I would get a form, which is the 1042S form, which shows that I have already paid 25% dividend on my dividends received, let's say for Microsoft or any other US stock. And then I would only pay the remaining component.
Understood. So you need to be aware of the extant laws as far as taxation, but just a limited point, Prableen, on the taxation of mutual funds, which you pointed out is similar to debt funds. Wouldn't that actually be superior in certain cases because of the indexation benefit to equity investments?
Absolutely. Yes, especially over the longer period, Alex, I think that can be a very good thing. And also, all of these instruments, because they are considered long-term, short-term, they can always be set off against each other. There are certain losses in India, let's say in certain stocks, and you have other investments abroad. And over a longer period of time, definitely indexation can really help reduce, especially given the inflation in India. I think that can work in an investor's favor.
Prableen, it's been an incredible conversation. It's been really insightful, and I'm sure that a lot of my viewers will be much more knowledgeable than they were at the start of this show, and that really is the objective. Thank you so much for taking the time.
Thanks, Alex.